DiMartino Booth. Danielle, let's start with this. I think we're going to bring something up here. We're still on this chart. Anyway, okay, here we go.
Here we go.
Remarks by Alan Greenspan. This is what I love about this. This is May 6, 1999, and he's talking about how they're having a trouble understanding the economy, especially, right? Forecasts of inflation have been off, right? Including the Federal Open Markets Committee, generally for several years. So here we had the Fed that couldn't figure out inflation back then. We have a Fed now that sees inflation as more of a threat than the jobs issue, and that just confuses me.
It should be confusing unless everybody on the FOMC needs glasses, because inflation is not a problem, not near as much of a problem as the fact that, as you mentioned, when you exclude healthcare, when you exclude healthcare and private education, and think of that as being the people training nurses to take care of baby boomers,
right.
We created 636 jobs a month in the private sector last year. 636.
636. There's no other zeros with that.
No zeros.
Okay. Wow.
Hundreds. So this is not a productivity miracle. We saw unit labor costs in that same report decline by 2.4% over in the third quarter of 2025. Right. If your unit labor costs are falling and productivity is rising, that means you're squeezing more out of every employee.
Can we bring up the productivity chart, guys, since we're talking about it, and it's the next question in the prompter? All right, anyway, we'll get that up here. Let's talk about this for a moment. Non-farm. This number shocked a lot of people, 4.9%. But does it come at the expense, right? Real hourly compensation was down. Unit labor costs made a massive reversal.
Exactly.
And I've always argued, right, I know about the productivity miracle. Does it really mean, is it a euphemism for, hey, we're obviously getting more out of individual workers, but does it mean at this point we don't need workers?
Exactly. They're getting more. It's not a miracle for the people who still have jobs, and they're being asked to work double what they were before. So that's no miracle. That just means you're more exhausted at the end of the day and really grateful to keep your job.
Right.
But this is an economy where we need private job creation, Charles.
So let's talk about then the workers, because workers are, to your point, they're scared. They're like a long-tailed cat in a room full of rocking chairs.
That's what this is.
Yesterday, folks, this is the New York Fed, right? And the question is asked: if you lost your job today, and could you get another job within 3 months? You can see this number has plunged. That's the lowest level since they've been following this, I think, back to 2012.
Right. Yep.
That's a lack of confidence. That has to translate to the economy, no?
It absolutely does, and we're seeing it. Outside of the top 10% who are responsible for 50% of consumption, thank you, stock market, we're seeing discretionary spending absolutely collapse. People are canceling plans to take vacations with their families. They're not confident enough to plan for the future because they're worried about losing their job if they have one, and they're really worried about finding another job if they do lose their job.
So then, I mean, it's not a mirage, right? And listen, I know economists, particularly at the Fed, they don't care how we get to the number. If the number is great, they don't care if it's 2 people driving it or 200 million driving it. And so how would that...
Which is a shame, because they're supposed to be making monetary policy for everybody, Charles.
Right. So you mentioned the stock market. Let's talk about that, right? Before we even get to, well, we'll talk about this because...
There's the stock market.
You had a lot of great tables in your most recent chart. You always do report. Superficial bull. What does that mean?
That means that if you're seeing inventories falling, right? Companies don't want to hold on to inventories. They're not confident that they're going to be able to go through those inventories. They're not building. If you're seeing new orders fall, which we are, they're both in contraction.
Right.
And the stock market's going in the absolute opposite direction. That means that there's nothing fundamental in the economy driving the stock market, but rather tons of passive flows. Every time somebody gets a paycheck, it flows into their 401k,
but
and that buys the market.
And this is the question I've been posing, I mentioned at the top of the show. Can this be a new reality, considering AI and technology? Can we have jobless prosperity? I know it sounds oxymoronic, and maybe it can happen, but it won't be long-lived. But can we actually have a booming economy, a booming stock market, a wealth machine, even as more and more Americans become disenchanted?
You know what? You said it won't be long-lived. And that's the point here.
Right.
We had the net worth come out this afternoon. We saw that Americans are now losing money with their real estate. And the only thing that's causing their net worth to increase is the stock market. At some point, it's only going to be a handful of stocks that it's holding up an entire economy. Charles,
so real quick, then, what would you like?
Forever.
What do you expect? Two questions in 30 seconds.
Oh my gosh!
What do you want to see the Fed do? What do you anticipate the Fed will do this year?
I think the Fed should be paying attention to the fact that small businesses and individuals have crippling borrowing expenses. They should be lowering interest rates. But you're right, they're not paying attention to the right data, and they're not making policy for the right people. And that's
Great
a shame.
stuff. Great seeing you.
Good to see you out here.